Hi, this is David Daughtry from Copperwind Financial. I just wanted to touch base with you guys a little bit and explain a little bit of what is happening in the banking world, both in the US and globally. You have probably heard some news feeds talking about Silicon Valley Bank, SVB as they refer to it, which was the 16th largest bank in the US. It was shut down last Friday. And you probably want to know, so what exactly happened? Well, it wasn't the typical banking crisis where they make bad loans and then all of a sudden they take losses and they're insolvent and nobody knows what they're worth because nobody knows what the loans are worth. What they did is, and they are a sort of a unique bank in that they cater to a lot of private equity and venture capital funds in the Bay Area. That's where they come from, Silicon Valley Bank, aptly named. And their business model was such that they had very large deposits, not mom and pop operations, and individuals that had a lot of money deposited in their bank. Over 90% of their deposits were uninsured, meaning they were above 250,000, because in the banking system, FDIC insurance covers for each taxable person or tax ID number, $250,000. Most banks, the vast majority of their deposits are insured, and this bank had over 90% uninsured. So when people get nervous, they pull money out. Why did they get nervous? They got nervous because over the last few years, that bank had bought a significant amount of very, very good bonds. They were government guaranteed bonds or mortgage backed securities. And the two assets that banks invest in is they originate loans, credit cards, corporate loans, mortgage loans, car loans, all those types of things. But if they don't have it, and that's what they really want to do because that's where they make the most money. On the other side, what you end up with, if they don't have enough loans, they'll go out and buy securities, bonds typically, or mortgage backed securities. And that's what SVB had done. The problem that they had was that when interest rates went up over the last year dramatically, as you've seen, the Fed is trying to raise rates to tamp down inflation and get it under control. Rates go up, bond prices go down. And that was the classic issue here with this bank. And the crazy part is they could have easily hedged that interest rate risk so that their hedge would have offset that, or they could have sold the bonds, and they didn't. And so when they went to sell some of the bonds because they needed money for depositors that got nervous, they took about a 1.8, $1.9 billion loss, and that spooked the market. And so last Friday, that was shut down. There was another bank that was shut down called Signature Bank. Sort of the same thing. A high percentage of deposits that were uninsured, and they had catered to the cryptocurrency firms and that area of the market, which is a very distinct part of the market. Over the weekend, what the Federal Reserve, the FDIC, and the Treasury did is they came out and said, "Look, these were isolated cases, and what we're going to do is we're going to set up a facility where if they've got bonds that are government guaranteed, so that we know we're going to get paid back, you can go and pledge those and borrow money from the Federal Reserve at the face amount. So in other words, you paid $1,000 for a bond and it's worth $900 right now, you could go and you could borrow against it at 1,000, because that way you don't have to recognize the losses. The Federal Reserve says as long as we hold the bonds, you're going to be fine. So that's what they did. And when you look and say, is my money safe at the bank? Absolutely, it's safe at the bank, up to $250,000. If you've got more than that, then you probably should spread it across other banks. Now, one of the things that happened with both SVB and the Signature Bank is over the weekend, the FDIC said, we're going to guarantee all of it. And they do have that option if they think it's going to not insuring all the deposits, if it's going to destabilize some in the banking industry, and that's what they did. Whether they will do that going forward, they can make that on a case-by-case basis. But when we look at, and look and say, so does the banks, are they all going to fall apart like they did in 2008 or back in during the savings and loan crisis in late 80s and early 90s? The answer is no. I mean, the banks are in great shape as far as their capital ratios. They're in great shape as far as their loan portfolios. If you remember back in the late 80s, early 90s, the banks got in trouble because they had a bunch of commercial real estate that went down in value and they had mortgages against it. In 2008 and 9, they had loaned on all kinds of residential real estate that went down 30, 40, 50%. We're not in that shape right now. Now, the other question that we've had clients ask is, what about our investments at Schwab and at TD or Fidelity or Merrill Lynch or any of those? How do I have to worry about my investments there? The answer is no, and here's why. If you think about what a bank does when you put money in a bank versus when you put money in your brokerage account, if you put money in a bank, you are giving them your money. And once you give it to them, then it's their money. You just effectively loaned it to them. And they say, hey, when you want it back, you just tell us and we'll give it back to you. But it's not your money anymore. It's their money, and you have a deposit account with them, whether it be a checking, savings, CD, whatever it might be. When you put money in your account and buy Apple stock or a mutual fund or an ETF or a money market fund, when you give that to TD Ameritrade or Schwab or Merrill Lynch or Fidelity, any of the brokerages, that's not their money. It's considered a segregated account. Think of it this way. If you went to the bank and opened up a safety deposit box there and put $1 million in it and closed it up and paid your safety deposit fee, if they were to go belly up and the FDIC shuts them down, they wouldn't go in and say, well, let's see what's in all the safety deposit boxes because that's the bank's money and we're going to get it. They wouldn't. They would call you and say, hey, you need to come get your money out of the safety deposit box. That's effectively what your account at TD Ameritrade or Schwab is. It's a segregated asset, and it's not an asset of Schwab or TD Ameritrade. So you don't have to worry about it there. Do you have to worry about if your stock goes down in value or bonds go up or down? Yes, that's just market risk that you take. But you don't take risk of them having all your money when they go if they were to ever go into default. And Schwab is in great financial shape anyway. So I wouldn't worry at all about that, but it's different. And there's also what they call SIPC insurance, which really is just covering if there were fraud or if there were any money where you'd sold something and it hadn't got reinvested yet. And usually that's a day in the making. So it's only in those scenarios where you'd have to look at. And people say, well, is this 2008 all over again? It's not, for all the reasons I've already talked about. The banks are in good shape. The corporations are in good shape. Individuals are in good shape. But it's a rocky ride at times when you're raising rates, and the Fed is effectively trying to put us into a slight recession. So anyway, just wanted to inform you of that because we've had calls about it. It's concerning anytime a bank fails, but these are specific scenarios. You don't have to worry about all the banks in the U.S. failing like we were worried about in 2008. So feel free if you have any questions or concerns, or I didn't answer a question you had, just reach out to us at any time, 480-348-2100. Thank you very much.